Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. Marcellus are known for keeping their strategies intact during times of market underperformance or relatively from our portfolio underperformance as well. But there's lots happening in the economy these days, and I would love to understand from Pramod Gubbi of Marcellus about how they are thinking at their end through all the multiple changes that are happening, and does that strengthen their resolve around certain beliefs, or does it weaken the resolve around certain things that may have not turned out exactly as they thought of when they first made their investments into, well, and there are multiple schemes, by the way. They are very large asset managers. Pramod, great having you. Thanks for taking the time out. Hope all is well.
Yeah, thank you. Thanks, Neeraj. Thanks for having me. Appreciate it. All well, by God's grace. Hope all well at your end too.
Yeah, touch wood. Pramod, the last 30 days, if anything, amongst all the other myriad changes that are happening, and we'll talk about them on the fundamental front, but on the technical front, the two big things that I see, and maybe one is a derivative of the other, is the point that there seems to be a near consensus view that we are at peak rates, even if the cuts may be a factor of 2024, if not 2023. And then the derivative of that is that we're seeing increasing fund flows into multiple countries, including India. I mean, I was recently reading, just today morning, reading a Bloomberg article about how the foreign buying of Taiwan stocks has hit a 3-month high as well. India has seen a rapid comeback of foreign institutional investors. So how do you characterize these with the kind of valuations that we may trading at? And what is it that you anticipate the markets to do over the course of the next 6 months?
Well, I think what the market will do over 6 months is beyond my
Anybody's
view. I think there are factors which are beyond our ability to forget about prediction, even comprehend. But I think I would agree with your view in terms of the market sort of accepting the fact that inflation is under control, given the sort of the sharpest rate hikes in 40 years now that the West has seen clearly has helped control that inflation. Recent inflationary numbers are also, I mean, they're not within range, at least now. For the first time in many months, we're seeing positive real interest rates in the world, where US inflation is below the Fed funds rate, which also gives the comfort to the market, and which is reflecting in now money sort of chasing risk assets, money moving away from the safe havens of the West and the US dollar into emerging markets. Like you pointed out, it's not just India. There are other emerging markets also benefiting from that flow. If that is likely to hold true, which is the peak of interest rates, and at some stage, whether it's 2023 or 2024, you see rate cuts, you can expect this sort of a fund flow to sustain, because at the end of the day, that money needs to chase higher yields and will need to get invested into risk assets. Within that risk assets, I think India tends to stand out. What we have seen personally in our own conversations with allocators globally, whether it's the pension funds, endowments, and foundations across the world, clearly there is a preference for India. I think the narrative has changed over the last couple of years for various reasons, both in terms of the risks of supply chain concentration in East Asia, particularly China, and also the geopolitical ramifications of the geopolitical issues that are emerging. India is emerging as the preferred hedge or the alternative. Naturally so, because whilst you mentioned Taiwan, perhaps Vietnam, or a couple of Southeast Asian nations, these are not large markets. If you're looking at an alternative to China, there are very few alternatives that come up in terms of size of the economy, size of the market that can absorb this amount of capital that needs to be shifted from China to India. So to that extent, India will take a lion's share of those flows moving from the West to emerging markets in general, in Asia in particular. But you're right in saying that at some stage, that'll also have an issue on valuation front. Luckily, we are at a stage now, quality has underperformed quite significantly over the last 18 months or so, to the extent quality, both in terms of absolute valuations as well as relative to value, is being attractive. And as we've seen, much of the foreign flows over the last 6 to 7 weeks have been allocated to perceived quality stocks. Quality, simply put, as a high return on capital stocks. So we're seeing a reversal of that trend. But at some stage, if we see a glut of these inflows, that valuation attractiveness could get bridged and make it sort of unsustainable in terms of a rally. But markets have always been irrational on both sides, and will perhaps continue to overshoot that equilibrium. As long as we find opportunities within the quality universe which are below intrinsic value, we will continue to be buyers in the market.
Yeah, actually, Pramod, as you said, the last few months or last few quarters, actually, maybe 18 months or slightly more than that, we're now at near flatline levels for the indices per se, as well as you mentioned, the quality universe, because value has made a big comeback. I know that, in my previous interaction, it sort of suggests that you guys were licking your chops and trying to buy into some of those names which you had because the profit growth was there, even if the valuation growth was correcting. My question is, are you now at some point of time trying to be tactical about when does the quality universe really start moving up? It has shown some bit of a movement in the last 15, 20 days or 30 days. Is it the time of return of growth and growth at a higher price versus value, if you will?
Well, like I said, the 18 months of correction, remember, it was correction both ways. Absolute prices, for example, if you take our portfolios as a proxy for quality, our portfolios on an average were down 15% in those 18 months, since October 2021 to March 2023. But earnings growth of the portfolio was on a 25% on an annualized basis, which means earnings were higher by almost 30%. As a result, valuations were actually down by 35-40%. Right. To that extent, valuations of quality had become very attractive. That is beginning to reverse. If you look at pretty much from the time the FII flow started to reverse, which is after the 24th March Federal Reserve meeting, our portfolios have made a comeback. On an average, they're up about 11% versus 5% for the market. Which is clearly suggesting that FII buying is buying more into quality, which is in turn triggering a reversal of sorts between quality and the market, and quality versus value. And this is the way value behaves. Remember, if value is all about the gap between the intrinsic value and the stock price, once that gap closes, that rally is pretty much done, because there is no underlying growth in the intrinsic value itself. Whereas quality continues to deliver even in times like this, because the valuation gap might get covered, but it'll sustain because the intrinsic value itself will continue to grow. So we haven't changed our investment philosophy one bit. Like you said, we've continued to rebalance the portfolio where corrections have been fairly irrational from a market perspective, despite earnings continuing to grow, stock prices falling sharply, is where we've bought more into them. Of course, some parts of the portfolio continue to do well, perhaps better than the fundamentals, and those are portfolios where we've trimmed. But no change in our philosophy. We are not buying into any stocks which don't fulfill those three primary criteria that we look at, where management is clean, capital allocation is sensible, and competitive advantages are sustainable. We're quite actually excited by the fact that the last 18 months have given lots of opportunities within that quality universe, because many stocks are trading significantly below their intrinsic values.
I wonder if you believe and I'm just trying to understand, if you believe this recent move, I'm trying to get to specifics now. You guys have been constructive on banks, high quality banks and financial institutions for a while. The Kings of Capital portfolio, for example, is testimony to that. Does this recent move of the government saying that 2,000 notes have to be returned back, etc., augur well for some of those financial names because it will be, in some sense, deposit growth accretive for a bunch of banks. And what bank doesn't like that? So I'm just trying to understand at a point of time when they probably will have opportunities to deploy cash into capex. Is this a positive?
Yeah, absolutely. I think the last 6 quarters or so, we've seen a recovery in credit growth, which is putting a pressure on credit deposit ratios in many banks. Right. So to that extent, focus of particularly the private sector banks that we've invested has been to look for avenues to grow the deposit base, and this comes as another tailwind. Which no credit to the banks in question, but yes, money lying under the mattress is coming into the banking system. To that extent, it should help deposit growth. But this is a one-off growth. So it might benefit all sorts of banks, both public and private. But I think the key will be those banks which are building a very strong liability base, a CASA franchise, will remain crucial to a bank's success, because that will allow them to earn margins without taking undue asset quality risks. And
Right.
and that's where something like an HDFC Bank or a Kotak Mahindra Bank clearly stands out.
I wonder, Pramod, at times like these, when the narrative also is that peak rates and a falling rate regime would benefit NBFCs quite strongly. Do you get tempted to try and allocate a higher proportion to high quality NBFCs? I mean, there are a bunch of them. You have some in your portfolio too. Is that the tactical play that you're doing? Let's say you are 100 rupees to invest in financials. Are they still going in the same way as your current portfolio stands, or is there more allocation towards NBFCs now, considering the peak rate narrative?
Well, we don't shift our allocations based on cyclical factors. So in the sense, interest rates go up and come down eventually. We look at it from a cross-cycle basis, but more importantly, we look at the liability franchise, the reputation of the issuer. In the case of NBFCs, they rely on the banking channel as well as the money market. The reputation of the NBFC in the money market. We do speak to FIG groups of large private sector and public sector banks who are lenders to the NBFC system regularly. We speak to bond fund managers and in the mutual fund and insurance space to get a sense of how they see the credentials of the NBFC, which is more of a structural aspect that we are trying to figure out. Because within that structural aspect, the long-term cost of borrowing for the NBFC can be established, which in turn can give us a sense of the intrinsic value of the NBFC. The only changes or the only factors that can change allocation to a particular stock or a sector is the gap between the intrinsic value and the stock price. If we believe for structural reasons, a company's or an NBFC's liability franchise has improved for good, that will obviously reflect in an upgrade to our assessment of the value, which in turn will drive an upgrade. But we're perhaps the last ones to react to any sort of cyclical changes. Sorry, Neeraj, I couldn't hear that.
Sorry, I'm saying let's avoid questions of large scale changes to portfolio. Excuse me for that mute. But let me try and understand from you, therefore, where is it, Pramod, that you guys in the last 6 weeks or 9 weeks and in the midst of this earnings season thought that these are the pockets where there exist the largest discounts relative to the intrinsic values and related to the risk reward that may be present, because sometimes discounts are for a reason. I'm just trying to understand, where is it that you believe even now or maybe a few weeks ago were the largest discounts to the intrinsic values as you see them?
Yeah, well, within our universe, which eliminates large parts of the economy, right? The cyclical sectors, commodities, public sector banks, public sector in general, are not part of our universe. But within our universe, we find a consistent trend because literally these 18 months of underperformance of quality has coincided with 18 months of relentless FI outflow. right? And the reversal also has coincided exactly with the FI inflow to that extent. So therefore, and also consistent with this trend has been in these 18 months, the earnings growth of these companies hasn't changed. They're continuing to deliver on that 20% sort of earnings growth. So to that extent, we saw many opportunities within our universe to build up positions. And particularly, I think private sector banks, HDFC Bank in particular, did not go anywhere in almost 3 years, despite earnings growth remaining in that 18 to 20% band. Kotak again similarly had a fairly muted 18-month period. So private sector banks, particularly the ones that who held up very strongly in terms of asset quality over the last decade or so, compared to the rest of the banking system, have been one of the biggest sources of dislocation as far as value and price concerned. Similarly, in certain select pharma, we continue to see value. We are holders of Divi's Laboratories, and that continues to show dislocation for stock-specific reasons. Here, it's unlikely that it's more of a quality versus value issue. It's a stock-specific issue, but we reckon that the long-term value offers significant margin of safety at this stage. Similarly, Dr. Lal Path Labs has had a terrible last 15 months or so, which again, we see an opportunity to build positions. So these are more stock-specific issues. If you ask for pockets, I guess consumer discretionary is continuing to offer that value versus price gap. And IT, although they may not be much triggers from a short-term perspective, given that we're likely to see sort of depressed environment, particularly given the state of American banking system, and banking tends to be a large part of the IT sector. But if you take a longer-term view, tech spends, cloud computing, these are not going to go away anytime soon. So to that extent, the long-term value remains intact, and the relative stock price performance over the last few quarters means that there is value emerging in that space for long-term investors.
Got it. My final question, Pramod, you would have traversed the length and breadth of the world, if you will, in the last 18 months to try and see, because I know you guys are raising money from across the world. Just trying to understand, where is it that you've seen a surprise interest, if you will, because there are some pockets that would be obvious investors into India because of the changing trends, what have you. And you have tremendous sell-side experience in this field, and so not too many things will surprise you, Pramod, I guess. But where is it that even you've been surprised with the kind of interest that global money, institution or otherwise, has shown into India?
Well, we tend to focus mostly on the institutional space in the US, which is largely pension funds, endowments, and foundations. But what's been surprising is, over the years, there were a bunch of these funds who were generally active in terms of looking at India allocation. But there was a whole host of funds who thought for them emerging markets was just China, and they were happy to be invested in China. But over the last 12 months or so, we're surprised to see many such institutions for the first time looking at direct allocation to India. At best, we were a part of some emerging market allocation for them. 7 or 8% was the index back then. It's grown up. India's allocation in the index. But several of them are looking at India as a separate opportunity now. And many of them are yet to build a proper understanding of India as an economy and market, which augurs well from a future perspective, because that money is yet to be allocated to India. So my sense is that we're in the early stages of many such institutions doing their homework. They're visiting in India in hopes. They're trying to learn the country. And as their understanding improves, we reckon the tap will open up even more. So far, we've seen historically active institutions allocating money to India, but we'll see a whole bunch of institutions which have not looked at anything beyond China historically, starting to allocate to India, which could create a new flow of foreign money, which takes me back to the original point that
Yeah,
a glut would mean that we could see sort of valuation issues crop up again across the market. Hopefully, we'll have many more issuers come to public markets and create more opportunities for investors like us.
well, maybe that's a happy problem to have as opposed to the other one, Pramod. But thank you. These are lovely insights. Thank you so much for your time and for sharing some of these insights with us. And of course, as I always say, look forward to talk to you more often.
Thank you. Thanks for having me. Pleasure speaking to you.
Pleasure was ours, and viewers, thanks for tuning into this edition of The Talking Point.